Okay, let's talk about ETFs. I mean, pretty much the go-to investment for millions of us, right? They promise simplicity, they promise diversification. But what if I told you that that very simplicity is hiding some traps? Traps that are quietly, sneakily eating away at your returns. Today, we're going to pull back the curtain on the 7 hidden mistakes that so many ETF investors make, and more importantly, how you can sidestep them.
And see, that's the real danger here. We're not talking about some huge, flashy, headline-grabbing implosion. No. These are the silent killers. They're the little costs, the flawed assumptions that just compound and compound over time, and they could seriously mess with your financial future, all without you even realizing it's happening.
So this is really the fundamental question you have to ask yourself. Are your investments actually set up for the long haul? By the end of this, you're going to have the tools to pop the hood on your own portfolio and answer that question with total confidence. So, let's get into it.
All right, our first trap, I like to call this one the safety net illusion. It's this belief that just by buying an ETF, you've automatically got this bulletproof safety net. This trap really has 2 parts: a huge misunderstanding of what diversification actually means, and a pretty dangerous underestimation of just plain old market risk.
And this brings us right to mistake number 1, just assuming that any ETF you buy is automatically diversified. Not all diversification is created equal, not by a long shot, and the difference can be absolutely massive.
Now check this out. This is a perfect real-world example. You've got 2 healthcare ETFs, right? But look at how they're built. They are completely different. The one on the left, XLV, it only holds about 65 companies. And get this, over half of its money is jammed into just the top 10. Now compare that to VHT over on the right, which spreads that risk out over almost 400 different companies. Huge difference.
And here's the visualization of why that is so important. With XLV, you're basically tying more than half your investment to the fate of just 10 giant companies. That is not the broad, safe diversification that most people think they're buying. So, what's the big takeaway here? You absolutely, positively have to look inside the fund.
And that leads us directly into mistake number 2, which is the other half of this safety net illusion. Even if you own the most perfectly diversified fund on the planet, you are not immune when a falling tide sinks all the ships. You are never immune to market risk. And this number right here is just a brutal reminder of that fact. Back in the 2008 crisis, a broad S&P 500 ETF, which is pretty much the definition of diversified, still lost about half its value. See, diversification protects you if one company goes belly up, but it can't protect you from the entire market taking a nosedive. Believing an ETF is totally safe is what causes people to panic and sell at the absolute worst time.
All right, moving on to our second category of traps, the silent killers. These are mistakes 3 and 4, and they are so insidious because they just work in the background year after year, slowly but surely draining your portfolio. I'm talking, of course, about fees and tracking errors.
So trap number 3 is simply ignoring the expense ratio. This is the annual fee that the fund charges you, period. Now, ETFs are famous for having low fees, and that's great, but they are not zero. And even a tiny difference in that percentage acts like a constant anchor, creating a serious drag on your growth over decades.
And that brings us to a related and very often overlooked silent killer: tracking error. This is mistake number 4. I mean, you buy an S&P 500 ETF because you want the performance of the S&P 500, right? Well, the gap between what you actually get and what the index did, that is the tracking error.
And why does this matter so much? Well, think about it like this. A small tracking error is kind of like a ship's navigation being off by just a single degree. Over a short trip, you'd barely even notice. But over the long journey to retirement, that tiny little deviation means you could end up thousands or even tens of thousands of dollars short of your destination. It's this hidden underperformance that can be absolutely devastating. Okay, our third category of traps isn't something you're going to find in a fund's prospectus. Nope, this one is found right between your ears. Mistakes 5 and 6 are all about those psychological biases that trick us into making just terrible, emotionally driven decisions, chasing after hot trends and trying to time the market.
Come on, we've all been there. You see an ETF that just skyrocketed 50% in a year, and that fear of missing out, that FOMO, is just overwhelming. This is trap number 5, chasing performance. It's basically like driving by only looking in the rearview mirror. History shows us again and again that last year's winners are very often next year's losers. A real plan is built on a strategy that looks forward, not one that's based on last year's headlines.
And that impulse to chase winners leads right into trap number 6, which violates this timeless, brilliant piece of advice. It's the belief that you, somehow, can be the one genius who jumps in and out of the market at the perfect moments. But the hard, cold data proves, for almost everybody, this is a losing game.
I mean, just look at the staggering statistic. Over 2 decades, if you tried to time the market and you missed just its 10 best days, your total returns would have been cut almost in half. And here's the cruel irony. Those best days often happen right after the absolute worst days, the exact moments when your fear is screaming at you to sell. It's really the ultimate proof that just staying invested is the winning strategy.
And now for our 7th and final trap. And honestly, this is maybe the most dangerous one on the entire list, especially for investors who are lured in by that promise of getting rich quick. Let's talk about the leveraged ETF gamble. On the surface, a leveraged ETF sounds like a dream come true, right? The market goes up 1%, you make 2%, or even 3%. But here is the critical catch, the part people always miss. They are designed to do this for one single day. That daily reset mechanism creates a mathematical trap for anyone who tries to hold on longer. Okay, let's just walk through the math on this slide, because this is so important. Day 1, the index is up 10% and your fund soars 20% to $120. Amazing, you feel like a genius. But day 2, the index gives back that 10%. Your fund drops 20%, but that's 20% of a bigger number. It's a $24 loss. So what's the result? The index is only down 1% from where it started, but you are down 4%. This is called volatility decay. And it's why in a choppy market, these funds can just bleed money even if the index they're tracking goes completely sideways. Okay, so we've identified the 7 traps lurking out there in the investing minefield. Now, let's flip the script. How do we actually actively avoid them? It's time to build your new playbook, the 5 core habits of a truly informed investor.
Really, this all comes down to shifting your mindset from just being a passive buyer to being an informed owner. Your playbook is super simple. 1. Look under the hood. Always know what your ETF actually holds. 2. Mind the gaps. Pay attention to fees and tracking errors because they compound. 3. Have a plan. A long-term strategy is always going to beat market timing and chasing the latest hype. And finally, understand your tools. Stay away from complex products like leveraged ETFs unless you are truly an expert. These habits, they are the difference between long-term success and falling right into these traps.
And that really brings us to the end. You now know about the hidden concentration risks, the silent fees, the psychological biases, and the structural traps that can sabotage even the best of intentions. The knowledge is all yours now. So the only question left is the one right here on the screen. Now that you know the traps, is it time to check your portfolio?